Well, thank everybody for attending today. I've had a great relationship with the team at FLAIA for a number of years, and it's a little different. I think what we're doing today. I think a lot of funds have, pitched at the beginning what they're looking to do, and then come on to raise money. We're actually at the end of our money raise, our fundraising part of the fund. And FLAIA was actually one of the first groups that we presented to back in October when we first opened the fund, October of last year. In fact, it was the first group after we took it to all of our existing investors. And so what I thought we would do is actually show you what we've achieved, excuse me, in the 10 months since we introduced this fund and showed it to the team at FLAIA back in October of last year. So with that, we're going to get going. The idea behind the ApexOne Special Situation Fund, when it was announced in October of 2020, my partners and I have been through, as you can have seen from the live video and the picture. I mean, we've been around a while, and this is the fifth recession we've been through. And we had a thesis that there was going to be opportunity, that there always is following a recession. We didn't know how long that opportunity would last, but we knew there would be situations that were arising. And some of the points that we saw that drove us to this conclusion is, one, we saw a slowdown in transactions just fell to next to nothing in the 2 months since after the lockdown started back in March of last year. We also saw something unusual happening in our own portfolio. We actually saw occupancy going up, and we primarily invest in workforce housing. And our theory, and then from talking to the residents that were moving in, is that they were moving from more expensive properties and they were just looking for ways to save some money. We also noticed that we had a higher retention rate of our existing residents, which means, typically during a lockdown, people typically decide, let's just, hunker down, stay here, do nothing. So they weren't moving out. So as a result, our occupancy started going up. We knew we'd seen an onslaught of development over the past few years. And we just had a feeling that some of these developers out there were going to be in a position where they were going to have to dispose of some assets prior to them meeting their occupancy and income goals. As many of you know, when a developer takes on a project, if you think about it, they start with a piece of ground. There's nothing for a lender to go against except the ground, but they need to borrow money to build. So since the lender has nothing to go against, the developers have to sign personally on these rather significant development loans. Once they hit a certain level of income that can support a loan, and once the project is substantially complete, well, there's some hard real estate to loan against, the lenders will then enter into an agreement with the developer called a mini perm or a mini permanent loan, which lasts 2 to 3 years, which takes the developer off their personal guarantee. We just believed that they were not going to hit the occupancy and income numbers because people just weren't moving. And we thought that we would have an opportunity to buy from some developers that didn't have the means to put more capital into those deals because they probably have another deal down the road they're working on and another over the horizon. And so that was kind of the basic theory. And we thought there would be 3 opportunities to buy from distressed sellers, again, not distressed properties. One, buying notes where there's a clear path to ownership. And that opportunity lasted for about 3 months. And that was late in 2020. So by the time we launched our fund, there really were no notes of good properties to buy. So we missed that. The second was acquisition from developers and owners under time constraints, which we just discussed. And the third was to acquire properties in overbuilt markets with a clear path to recovery. Again, the thought there is that they would not have their occupancy. We did a lot of research. And in fact, in February, we showed a piece on our research presentation how we identified the markets that we thought would be strong recovery markets following COVID-19, markets where people were wanting to move to. We bounced this idea off a lot of brokers out there that we work with. We have 3 economists on retainer that we went through our research project with, and they gave us some ideas. And so anyway, so we knew the markets where we wanted to go and where we wanted to look, and I'll show you those in a second. So we acquired our first property in March of 2021. We are actually acquiring our 9th property today. We have 2 more properties under contract. We have a healthy pipeline of opportunity. The fund is going to close later this year to new investors. We'll probably buy our last property in the first quarter of next year. We currently have $205 million that we've raised. We did that in 10 months. And we have another 40 million that's soft circle that are people that have committed to coming in, that are selling properties, are funding their partnership to come into our partnership. So we're going to be at about 245 million pretty easily. Our stated goal was 250 million, and we have the ability to go up to 300 million. A number of people on the call today, I'm sure, have been in a couple of our funds. We first started working with Mike and the team at FLAIA for our third fund. Last Monday, we sold our first property out of Fund 1. And those people that are on the call today that are in Fund 3, I'm sure were surprised. It was a property in Jackson, Tennessee. It generated a 61.4 IRR. We did that in 27 months, and the multiple return to investors was about 2.87 on a $6.2 million investment. We returned $17+ million to investors, and that property had been thrown off a 14% yield since we acquired the property. So that was a real home run for us and our investors in Fund 3. And we have one more property in Fund 3 under contract. We're closing in November, and then that fund will be closed out. That fund is not accepting investors, but Fund 4 still is accepting investors. And just as a quick picture, I think one of the nice things about coming in, and I'm going to go through the properties we've acquired in a second. For any of you interested in coming into the fund, I'll have some details at the back end of this, but you'll actually see the properties and how they're cash flowing. So one of the things that was really surprising to us as we move to the next slide and look at the the properties we have in Fund 4, either under contract that we've acquired or that we will have under letter of intent. When we started this fund, we had originally projected really very little cash flow in the early stages of the fund because we thought we were going to be in lease-up situations with these properties. And when we put them under contract, some were struggling. But I think everybody's read, the headlines with housing that occupancy is up across all property types, including single family for rent. Rents are up significantly. In fact, in our portfolio since April, rents are up 11.8%. Nationally, in the last 12 months, rents are up almost 14%. The New York Times, anybody you talk to, Wall Street Journal, kind of the same articles that there is a housing shortage of 5.2 million units in this country. The cost of housing is up 26% for single family homes in the last year. So what we're seeing is more and more people are just getting priced out of the single family home market. They are moving into apartments because that's where they're going to live longer. An interesting phenomenon we've seen in our properties down in South Florida. Whenever somebody goes to apply for to rent your apartment, you do a background check and a financial check on them as well. And it's not unusual to see good income to support renting an apartment in the $60,000 to $80,000 a year in income. But what surprised us with a couple of residents in our South Florida is they had $400,000 and $500,000 of cash in the bank. And so we asked them, what's going on here? That's unusual. The housing market is so hot in South Florida, as Michael and his team down there know. People are selling their houses because they see this as a generational opportunity to make an incredible amount of money. And then they want to come and rent a pretty nice apartment complex. And so we're seeing people that had owned now renting apartments. And we had never counted on that, but it's just an interesting phenomenon of what's going on in our apartments. So here you see our spread of properties on the map. And this fits right in with our research in this southeast quadrant of the country that we wanted to look at for a lot of different reasons. This is an example or a statement of, a chart showing the amount of money we've put out. It's, I think, unusual for a company of our size to raise the amount of money that we did in a short period of time. It's even more unusual for us to be able to put out the amount of money that we've put out in this period of time. We've put out over $180 million in properties, and we acquired our first property in March. So literally in 6 months, we've put $180 million to work. And so what you're also seeing in this chart is the distributions. Again, as I mentioned, we had not anticipated a lot of distributions from this fund. In August, our yield from our properties was 7.54%. That's just insane. We did not anticipate that at all, but the occupancy is up so high in these apartments, and the rent increases we're seeing in these markets are just nothing I've ever seen in my lifetime. We'll break this down a little more by property as we go forward. So this is where we are right now. So as of, this says 9/29, but as of this morning, we have $205 million committed to the fund. We've invested $180 million of equity in 9 properties, including one we're closing today that I just funded a while ago. We have 1 property under contract and 1 under letter of intent, and we'll invest another $50 million of additional equity in those properties. The final property is expected to be acquired in the first quarter of 2022. The next capital call will probably be in October. We've called 100% of the money from our investors, so all this money is working, and the final closing will be sometime during the fourth quarter for the fund. So this is, as we go through these slides, you're going to see what we call an ApexOne BBC community score. So one of the things that we did during the downturn, the pandemic last year, was we had a little free time on our hands, and a lot of you have seen these research reports that we put together. So we did 2 things to sort of prepare for this fund. One, we took the time, the properties we had owned and had sold were just generating incredible returns. And we're not foolish. We know we're in a tailwind situation with multifamily. But we didn't know we were in a tailwind where we're seeing some of the returns that averaged over almost 29% in our portfolio. And so we went back and we started looking to try to work with our team at Balfour Beatty Communities to see if we could identify certain demographic measures in these communities where we own properties, if we could see a trend of things that tracked. And we looked at things like income growth, income to national averages, median income. We looked at rent. We looked at dozens of demographic markers, population growth, the age of that population growth, average cost of single family homes, how long homes sat on the market, number of units under construction, anything that we could put a measure on that there was a demographic marker that we could attain, we did this. And then someone had the bright idea of, let's do this for all 3,145 counties and parishes across the United States. And we ended up with a data base of over 12 million data bytes. It's the largest Excel file I've seen in my life. We then said, okay, numbers can lie. And that's when we went to our 3 economists and said, how should we filter those? And we came out with these, 8 items, and things like, was it a good market before COVID? What's the strength of the healthcare system? How good are the schools in the area? What is the community doing to address climate change? And again, we thought that was important because we knew as these communities tried to attract new jobs, new corporations, they had to address things that were important to a younger crowd. We saw the communities in Florida that were traditionally retirement communities like a Fort Myers just making tremendous steps in doing this. Just as an interesting note to everybody living in Florida, of the 10 fastest growing communities in the United States, 9 are in Florida. The one outside of Florida is Myrtle Beach, South Carolina. And so we knew that there was going to be a continuation of people moving into Florida. Personally, I think what we've seen is, I will never knock New York. I think it's the greatest city in the world. But I think a lot of companies were looking at ways to get some of their people out of New York for employment costs and other issues. And the pandemic, they found a lot of them were staying at their second home in Florida. And you've now seen a lot of companies like Goldman Sachs, Morgan Stanley's, and others putting major divisions down in Florida. And I predict more of that is going to be coming. I think Miami, which is the financial capital of South America, more and more of the people I talk to on Wall Street are looking at South Florida. I predict in 10 years, Miami is going to be the financial capital of maybe the world. And so I think there's going to continue to be a migration into South Florida in those markets. But anyway, so what we do is we rank each of these communities by this Balfour Beatty score. And you'll see it in the example we give here is Legacy at Lake Charles is ranked 154 on the BBC scoreboard, meaning it's in the top 4.9% of the markets when you measure that against the 3,145. So that explains how we came up with this scoring system and how we evaluate markets against that scoring system. So this is the first property we bought. It's an interesting story. Legacy at 2020 in Gonzales, Louisiana. Everybody's going, where the heck is Gonzales? Well, if you know where Baton Rouge is, home to it's the state capital of Louisiana, home to the Louisiana State University Fighting Tigers. Baton Rouge is also the the seventh busiest port in the United States. It is the only inland port that has that designation because this is as far as these big ships and cargo containers can come up before they have to put them on barges and go to the Mississippi. So Baton Rouge is a great place to work. It's a horrible place to live, unless you're a college student. It has a fairly high crime rate and a lot of other issues going forward. And so what you've seen is people moving to adjacent parishes. Ascension Parish to the south, Livingston Parish to the east. So this property, Gonzales, is in Ascension Parish to the south. They've had so much movement into Ascension Parish, they put a moratorium on construction. So this was the last multifamily property built in Ascension Parish. When you drive out of the property, there's two retailers that I love, Starbucks and Chick-fil-A. And I can't think of a time I've seen a Starbucks and a Chick-fil-A go out of business. They do incredible research before they open stores. They invest heavily in those communities. And so we felt that this was going to be a very good location. It's a quarter of a mile from the hospital, easy access to the freeway to get back up into Baton Rouge to work. So it had everything we liked in our scoring system. But what was really interesting about this deal and the way it came to us is this property was actually under contract. A local developer in Louisiana had it under contract to a group out of New York. And the developer was leasing the property very quickly. He was hitting his numbers, and the buyer had a takeout at a certain number. And so when he saw the developer passed on his conversion of the loan to a mini perm. So he's still on his personal guaranteed note, and it was going to expire at the end of March. The buyer that he had lined up that had committed to buy the property kept delaying. Then he started retrading the developer. And if many of you guys, men and women on the call today know the developers from Louisiana, they don't like to be retraded. The developer got very upset with the seller. He called the broker and said, you need to find me another buyer, someone that can close quickly. Well, let me take a second out here and tell you the other thing that we did during our downtime in COVID when we launched this fund. We went out and talked to every broker we knew and told them what our thesis was. We thought there were going to be some distressed sellers out there. And did they know some? Would they help us? And they all said, great strategy. We like it. We think you're right on point. 38 of those brokers actually invested in this fund. So I've got 38 of the nation's leading brokers invested in my fund out looking for deals for me. This broker that had this property sold was one of our investors. And he called us and said, I might have a deal for you. And told us the story. He says, the guy will actually give you a discount. He'll sell it to you at the discount the guy from New York was asking if you can close before March 30th. And this was in January. And so we were able to put this deal together and fund it, and we closed on March 15th. So look at this deal. It's thrown off. If you look at the fourth bullet point, the fifth bullet point, this property has made a distribution every month since we acquired it. That was a 10% cash on cash yield. The property is 100% leased. And as y'all know, we had a hurricane go through and visit Louisiana. These properties are all built to the newest standards. It withstood the hurricane, no problem. Yes, we lost power, but we also had people lining up at our door trying to find a new place to live because some of the old apartments just took a hit. So this has just been a real home run. You can see the Balfour Beatty community score there is 473. So again, it's in the top 12% of markets in the United States because of what's going on. The next deal, Mission Escondido luxury apartments. And so this was actually the first deal that we saw in the fund. And the way we came across this opportunity, we were having calls with our current investors. We introduced the fund first to them to give them the first opportunity to invest. We finished the presentation and our phone immediately rings, and it's one of our investors. And he says, hey, I think I may have a deal for you guys. I am a joint venture partner in this property in San Antonio, Texas. Great market. And we've been in this deal for 6 years. The developer just issued a request for a capital call, and my partner, there's only a handful of people in this deal. We don't want to put in more money. We're ready to exit this deal. It's been too long. It's tired. So this gentleman just got caught upside down in COVID. So we put it under contract in November of 2020. It was 48% leased. This is one of the nicest apartment projects I've ever seen. The land was partially owned by the Catholic Church, so it took a long time to work through that. There's a lot of city and county involved. It has a tax abatement for 5 more years, I believe. It was just a long time to get built, but it's a gorgeous property. But during COVID, everybody just sat still and did nothing. He originally tried to rent this at about $1,700 to $1,800 a unit. He brought it down eventually to about $1,500, still had no traction. So when we put it under contract, the contract was contingent on us getting approval by the city and county, which they couldn't refuse it, but we just knew it would take time. And the developer agreed to move the rents down to our projections of $1,143 per month. So we eventually closed on the property in May, and we underwrote this property to take 2 years to lease to 95%. We underwrote it that there would be no rent increase in year 1 and year 2. Year 3 would have a 3% rent increase, year 4, a 3% rent increase, and year 5, a 4% rent increase. As of 2 days ago, we were 99.4% leased, and our rents are up 10%. So in 5 months, we have blown through our 5-year projection of this property. We bought this property for $153,000 per unit. Today, we could easily sell it for $225,000 a unit. So again, it was a seller in a distressed situation, had to move the property, loan coming due, and we were able to move on it quickly, and again, in a great community. Legacy at Lake Charles. So this is interesting. So the developer that we bought the property from outside of Baton Rouge, he was in default on a note to a lender, had to raise capital very quickly. After we had the very successful closing on the other property in Gonzales, Legacy 2020, he came to us and said, I have another deal I'll sell you. We already have the contract negotiated. I'll give you a great price on this deal. I need some money if you guys can close quick. So we closed on this property on May 28th. And again, you can see the distributions for the months that we've owned it, June, July, and August, $105,000 a month. That's 10% annualized. The property is 97.8% leased. And with the move-ins that we have coming in this weekend, we'll be back to 100% leased in this property. Lake Charles has a score on our Balfour Beatty ApexOne scale of 154, making it one of the top 4% markets in the country. And again, it's just phenomenal what's going on in Lake Charles. So again, you're getting a look at the deals that are actually in the fund right now. This is Cape at Savona in Cape Coral, Florida. It's outside of Fort Myers. Here, again, same situation, just a tremendous Class A property. So just a note on this deal and some of the South Florida deals, I mentioned to you that we have 38 brokers that are in our fund. So of the 9 properties we own, 7 of them were brought to us and they never saw the market. We were the only people the developer was talking to. And the reason is these brokers that we've worked with know our reputation. When we say we're going to close, we're going to close. We don't retrade. We don't believe in doing that. We believe in long-term relationships, multiple deals with investors. And so that's important to these sellers when they've got their head against the wall that they've got to sell, or they've got to come up with money they may not have. They need somebody that can close. We love the South Florida market. We've been very successful there. Again, this is just a tremendous asset that we acquired on June 17th. We had projected a 7.7 cash yield over the duration of the loan. We hadn't projected much, going in. And so now we're 100% leased at this property. It's throwing off an 8% yield in July and August. But more importantly, what we're seeing in these opportunities I'm showing you, we typically are underwriting these deals with 10 to 15% rent increase over the 5-year period that we own them. Some will be up in the 16% range. Again, that's total over the 5 years. In South Florida, we're seeing rent growth of 10 and 12% in the last 60 days. And what's interesting is these rents are still too low to really support new development with all the restrictions that are being set in South Florida and the cost to build and rising construction costs. We've all heard lumber prices are coming down, but land costs continue to climb, labor costs continue to climb, and a lot of the other materials that you need, the costs are climbing and they're just in very short supply. So again, we think that the demand for rental properties in South Florida is going to continue to be strong, but so this was a good property. This was the standard Eastpoint. This is another situation with a distressed seller. The story on this property is they had it under contract. The previous buyer, during due diligence and title work, found out that this property was built on a site that was not entitled for multifamily. And the challenge the lender had, and again, nobody quite knows how this happened, but it did happen. Just, thank you, Texas. These things happen down here on occasion. So what happened is if there was a fire or something happened at one of these properties, you could not rebuild this property because it's multifamily was not allowed. So you couldn't get insurance, you couldn't get a loan, the contract fell out. A broker who was an investor in the fund brought it to us and said, guys, is there anything you can do here? And so we used our contacts at the city council and the county in Harris County and Baytown, Texas. And we went to the developer and said, look, we'll pay you X price. And we got a pretty good discount, but we think we can solve this problem, but we need time to solve the problem, to see if we can get this re-entitled for our multifamily. We think it's a technical issue, not a hard zoning issue. And for those of you that don't know, Houston, Texas has no zoning. But one reason we like Baytown is this is one of the few communities in the Houston market that has zoning. So we felt we were protected. And it's just a great location. So we worked with our contacts and we told the developer, if we can get it approved, we will close within 7 days. Here's a significant amount of money we'll put down on the property. So sure enough, we got it through zoning, got everything approved, boom, closed in 7 days. We had projected a 7.3% annual yield, and in July and August, we are at a 10% annualized yield, and the property is 95% leased. And look at the community score, 12. This is a hot, fast-growing market, just doing extremely, extremely well, and this is the best property in the market. And that's our goal with this fund, is to acquire the top 2 to 3 properties in the market. This is San Mateo Crossing in Kissimmee, Florida. So when we did our research, we identified, when we started identifying markets, we thought there were going to be some markets that were struggling tremendously post-COVID, but would have a longer recovery period, something more in the 2-year time frame. And Kissimmee was one of those because it's part of Orlando. But we believe that the people that run Disney, Universal Studios, they're pretty smart. They're going to figure a way to get people back in those parks, get people reemployed. We also knew Florida's, again, just a great market to be in. Orlando's always been one of the fastest growing markets in the country. And so if we had opportunities to buy there, we would. And so we picked up San Mateo Crossing in August of this year. And again, as you see, all these properties are fairly new, 2019, 2020 vintage. These are, Dr. Peter Linneman, who's one of our consultants, our economic consultants. He was former head of Wharton at Pennsylvania. And he had an interesting observation about our fund. He said, I think it's the only fund out there that I'm seeing focused on multifamily that is targeting distressed sellers. He goes, that's a very interesting. And he was part of the strategy that helped put this together. He says, what's interesting about your deal is that you're buying core and core plus properties. You're getting opportunistic returns, 16 to 18%, and you're getting workforce cash flow. He says, I've never seen a fund that has all 3 of those traits. And so we know this is sort of a generational opportunity to buy these properties. So here we have a brand new property. We had projected to throw off 7.4%, and the August distribution was 8% annualized. The property is 99.7% leased. And this market has a Balfour Beatty score of an ApexOne BBC community score of 320. So this is part of that I-4 corridor between Orlando and Tampa. And there was a study a couple of weeks ago, it's either in the Wall Street Journal or the New York Times, that showed that that corridor alone, if it was a state, it would be the 11th fastest growing state in the country. That's how many people are moving into that I-4 corridor, which Michael enjoys because it keeps a few more people out of the Miami growth market. This is Sausalito, another property we bought in Kissimmee. We just closed on it in July, so it has not had a distribution yet, but at 98.7% lease, we think it's going to exceed at 6.9% average. But again, just a ultra high quality property. Alexan in Lower Heights. This is a property in Houston, Texas. It is in the Heights area of Houston, which is the the central point of the Houston market right now. It's on the I-10 corridor between downtown and the Energy Corridor and the Galleria area. So it's built to attract a young crowd. It's very vibrant in this area. They can go anywhere in the city. It's got bike paths. It's got walk streets. This is the most amenity-driven property that I've ever seen in my life. And we did something a little bit different here. A couple of years ago, we invested in a company called NALU. And our industry, we know the least about our residents of anyone out there. The cable company knows more about our residents than we know. And I don't mean that in the sense of we know they're good people, we know they can pay the rent, but we just don't know those drivers behind them. And to kind of give you an example of what NALU does, they try to help you identify the residents that come in by using a 10 to 12 question item. And by answering those questions, we can project certain traits of these residents. And the example I can give you that they gave us is if somebody drives up into your project to look to rent your apartment and they're driving a Subaru, you should do whatever it takes to lease to that person, because they're going to stay in your apartment between 7.5 to 8 years. They're going to pay their rent on time. You're never going to hear from them. In fact, they'll probably pay the big rent increases because they just don't like to move in with all these traits. We've never understood that type of information. The other thing that NALU does is it goes and breaks down every apartment complex you compete with by the size of the units, and they help you look for missing rent. And so we've rolled this out on other sites, and we used it on this property in Alexan and Lower Heights. And we identified $1.2 million of missed rent that we think we can recover very quickly in this apartment complex. And again, this apartment is brand new 2020 vintage. It leased up faster than any apartment complex in Houston. It did it in less than a year. It is the high demand spot. And we closed on that 2 days ago on the 28th. And then the final property to really show you is Grand Central in Fort Myers. This is the property we're actually closed on today. So this is an interesting property. We underwrote this property to have 16% rent increase over a 5-year period. From the time we put it under contract 2 months ago to today, rents are up 12% in 2 months. There are only 4 units available in the apartment complex. And so again, we just see tremendous value. Conservatively, we think that since we've acquired this portfolio, if you remember what I told you about Mila, we bought it for $153 a unit. It's now worth $225 a unit. We think we have tremendous additional equity in this fund already. Conservatively, we think it's about 10 to 15%. So we think we've picked up $20 to $30 million of equity just on the buy, that if we go to refinance these properties, that we can send a lot of those proceeds back to the investors, or we can just hold on to them, enjoy the cash flow, and sell them at a big sell down the road. So that's the properties that we have under contract that we've acquired. Meridian at the Port, I was actually just visiting this property, and last night I met with the lenders over in Mobile. We've owned 4 or 5 properties in the Mobile area. I've been going to Mobile. I grew up in Alabama. I went to Auburn, and I've been working in Mobile off and on in the real estate industry since 1989, when we acquired a portfolio of properties from Alcoa Aluminum. And so we really like what's going on. And Mobile is just a real hidden gem on the southern coast. A number of years ago, a gentleman by the name of Mike Dow was elected mayor. And his goal was to reunite the city and to reinvigorate downtown Mobile. And the crown jewel of that accomplishment 20 years later was the development of this first Class A institutional asset apartment complex downtown. It's right on the bay. It has great views. It may be, next to Alexan, the nicest apartment complex we've ever owned. And what's been interesting is Mobile has done a great job of attracting new residents from out of town. When we toured the property last night, we talked to a number of residents. And what they'll tell you is that they moved from Houston, they moved from Atlanta, they moved from Richmond, and they moved from high-end, and they lived in high-end podium-style apartment complexes, not the suburban, where you have 30 buildings in the complex and 10 units per building. They wanted something much more urban, and this was the only opportunity available. In fact, I think this may be the only urban style property in the state of Alabama that looks like this. So the property came online right during the pandemic. The developer was worried. He gave significant concessions. The property leased up in less than a year during a pandemic. Rents are trailing its competitors in West Mobile by 20%. So we've got the nicest property in the market. Most of the people work downtown and they're paying low rent. The developer has been increasing rents by 20%. This last year, as they've rolled over, people are paying those rents. We underwrote it to have 4% rent increases. So we think we're going to do very well in Mobile as well. So we're real excited on that. We'll close on that deal in October. And that's sort of the summary of all the deals we have. So what we're going to be doing for the rest of the year for 2021 is to continue to manage our lease up and focus on resident retention. We're big on that, service delivery, revenue enhancement, and expense control. The first quarterly distribution goes out in November. We hadn't anticipated very much, but it looks like we're going to distribute about $2.7 to $3 million in November to the investors of record. You have to be in actually by today to be an investor of record into Fund 4 to get a distribution. We'll probably buy 1 to 2 properties per month through the rest of the year, acquire our last property in Q1 of 2022. We're going to close the fund to investors sometime in the fourth quarter because I think we're going to max out between 250 and 300. We continue to see deals and opportunities. They certainly weren't as good as they were at the beginning, but the properties we see in still have strong traits and still will help us meet the objectives of the fund, which to run through those. We're targeting a net return to investors of 16 to 18%. There's that opportunistic return we talked about. Preferred return to investors is 8%. Again, that's strong. Projected yield of 6 to 8%. I think we're going to hit that pretty easily. We thought we were going to be a little bit lighter. Targeted multiple on invested capital is 2 to 3x. The fund life is 7 years. The investment period is 18 months from the first closing, so we're running low on that. The minimum investment is $1 million. That's for our institutional clients. We let investors in at a lower minimum. If you've invested with us before, we let you come in at whatever amount you were in at. But if you, we like to stay above 100,000. But if anybody has any questions about that, you can certainly give me a call or email. The asset management fee is 1.25% on called capital. And there's a GP carried interest. We get a 20% carried interest after the LPs have received their preferred return of 8% in return of all their contributed capital. So we're only going to make money after you get all your money back in your 8% return. And this is the team that we have in place that has put this program together. So we're pretty lean. A lot of different backgrounds coming together here. Jim Hearn, Tim, and myself are the managing partners of the firm. We own 95% of the company. Bill and David Steele, we own 93%. David Steele owns 5% and Bill owns 2%. Our asset management team, headed by Chris Gullidge, includes Ryan Simon and Gwen Pham. Our asset managers are a little different. They all have on-site management experience, so they know how to run properties, and we work hand in glove with our third-party managers. We only hire best-in-class third-party managers. Many of them co-invest with us in our previous funds. And this fund, except for one deal with Balfour Beatty, we have 100% of the equity in the deal. And then our acquisition team of Tim Burns and David Steele is supplemented by Nick and Travante. So that's our story of what we've been doing in Fund 4. And I'll be glad to answer any questions. Before we get to the questions, I'll see if we see anything pop up here. The other thing we want to talk about just real briefly is what the outlook for housing is in the country in the coming years. And as we mentioned earlier, God bless them, but we just don't know how the dream of home ownership is going to continue to expand. There's less than a 3-month supply of houses available in the market right now. And while the for sale market is cooling down, what we are seeing is the entry of the single family for rent buyers, these large pools of money that are being generated by institutions that are out buying these properties. They're doing them, they offer close on your property in 7 days, and that's who sellers are selling to. They're not selling to the families that want to actually own and occupy. So they're certainly taking a lot of the properties off the market. It is almost impossible to build a starter home that is a home that costs less than $300,000. The average home in America right now is about $360,000. That's up $100,000 from a year and a half ago when it was $267,000. Credit, while interest rates are down, it's still staying difficult to pull a loan together for a home without a significant down payment. A lot of the movement last year in the home buying, we believe was, and this sound a little morbid, is with all the deaths that happened during COVID-19, a lot of people inherited money and they went out and bought a home, and that's good for them. And that's part of what led to the push in the single family home sales last year. And now it's just getting harder and harder to bring that supply up of single family homes. California is trying to make some really strong moves. About half of the housing shortage in the country is in California because the pricing has just gotten so extensive. And part of their solution is the de-densification. That is, they're allowing you to put more properties per acre, going vertical, which means most of these units are going to be smaller, which doesn't necessarily help the families that need 2 and 3 bedrooms. Another trend that we're seeing out there is the conversion of student housing properties to apartment complexes, to traditional investment complexes. We've done 2 of those very successfully, each had a return of over 30%. And the reason those have been successful is, and these aren't right on college campuses, these are, shadow campuses of, half a mile or a mile away. A lot of these are 4-bedroom units, and we go in and convert them to 3-bedroom units with larger living rooms or a study, and that's ideal for a family. And these complexes typically have huge amenities, significant weight rooms, study rooms, which you can convert to places where people can go and work if they're working remotely. They have huge pools. They have room for playground. So families are eating these up. So when a family can't find a 3-bedroom home to rent, if they can go to an apartment complex with 3 bedrooms, they do that. And typically, developers always build fewer 3 bedrooms than anything else in their projects. So that's a trend that we're seeing with some of these conversions. There's a lot of people looking at a lot of different ways to solve the housing problem. We don't know what it is. We know that when the government gets involved, that's not necessarily a good thing. For those of you from Houston or have followed this story, our mayor is in a little bit of hot water. They had money set aside for an affordable housing complex, and they put it out to bid. And one group bid to build a 360 unit complex. The cost is going to be about $16 million. But instead, the mayor is being accused of steering this deal to a company that he used to have his former law partners have ownership in, and they're spending $15 million on an 88-unit affordable housing complex. And so those are typical of the stories you hear. So government involvement is not necessarily solving the housing problem. It's going to be up to the private sector, we think, to do this. And we think the solution is going to be in multifamily rental type properties, and more people are just going to accept that renting is their way of life. We're certainly seeing it with higher retention rates. People are staying in our properties longer. So we don't think there's an immediate solution to the housing crisis. Some good minds are out there working on it, and we'll eventually figure it out. But for now and for the foreseeable future, we think that the opportunity is there in the multifamily sector. The other question that I've gotten in the past is regarding some provisions of the tax law and how it's going to impact multifamily and real estate investments. The only one I've seen that could have impact on us is there is a provision that is going to potentially eliminate the ability of people to use their self-directed IRAs or even their IRA accounts to invest in private partnerships. We believe that is going to be taken out, but it is out there right now. There is also some legislation, regarding some assistance in affordable housing, which doesn't really impact us that much because that's not the area that we invest in. I think some of the more interesting provisions is provisions for, the use for addressing elderly housing in areas that really need some attention and need some focus. And so that should be impactful. But, right now, we're not really seeing anything that's too impactful to our industry. There is talk of moving the capital gains rate up, but, a rising tide either, lifts all boats and a lowering tide lowers all boats. That just, even if they take the capital gains rate from 25 to 29%, we still think it's very favorable for our industry. This fund is set up as a limited partnership. We use accelerated depreciation, so we actually make distributions that are not taxable until we sell the properties, and then the gain on that sale is typically at the lower capital gains rate, and you can use the losses that you were not able to use during the year to offset some of those gains when we sell as well. So real estate in these types of funds, not just ours, tend to be very tax efficient. So Michael and Jeremy, I've talked quite a while. I don't know if there's any questions out there. If anybody has any, I'd be glad to answer them at this point, but that sort of wraps up the summary. Again, we're open to investors still. If you have any questions, I'll get my contact information up here on the screen real quick. Go through there I am right there. No, there I was. There we go. So if anybody has any questions, feel free to email me or call me with anything you'd like to know. I'd be glad to discuss it further with. I'll say this is a very unusual opportunity to actually see the properties in the fund. This is not a blind pull anymore. It is actual investments in ApexOne, and we're very pleased. We've had over 94% of our investors invest in all of our funds, so our retention rate's very high. Most of our investments come from friends of referrals. Mike and his group have had a significant impact on our success. I think we've raised about $15 million from people who have sat through the presentation or their advisors who've seen this presentation and introduced to their clients. So thank you all for the great work you're doing to help ApexOne be successful.
A fantastic job. What's the plan? Is there going to be a fund number 5? When do you anticipate that fund coming out?
Yeah, so Fund 5 we're already working on it. Thanks, Michael. And y'all will certainly be the first to see the presentation. It is going to focus on a core and core plus strategy. So it's not going to have the yields or the IR of this fund. We think the value add space is just so overpriced right now, and there's so many people trying to buy property in there, and the properties are just getting older and older. And given the relationships that we have, coming out of Fund 4, we think Fund 5 will literally be a continuation of continuing to buy core plus assets in markets that are either overbuilt or that we feel have strong economic drivers that are going to push jobs. We are going to look at markets where there are constraints to building. We may look at a couple of conversion properties. There'll probably be a small development play in that property and in that fund as well. We have already reached a handshake agreement with a lead investor for $100 million coming into that Fund 5. And we will soon be putting together the documentation. As always, we will give our current investors the first shot to invest in that. And we think that will be a $350 million to $500 million fund. It's probably going to run a little longer. We believe it will be a supplement to the fixed income because the cash flow from these properties is so strong, low interest rates on the loans. We think they'll generate, those nice yields in the 6% starting out, and then rise, gradually up into the 8 to 9% range. And just given the ongoing demand for multifamily housing and the rents, we think that, like I say, it'll be a nice supplement to people that can't get the fixed income from the bonds. And so that will probably be announced sometime late in December. But I promise you, Michael, it will first be seen on the FLAIA site.
Thank you. Thank you very much, Ernest. What is one of the things that I guess COVID has taught the firm, and one of the things since you first came out, with fund number 4, outside of the suspicion and distress, what have you guys learned from this?
I think what we've learned is to not follow. Well, I'm trying to say it learned, but I've reinforced is to look beyond the headlines regarding real estate. And we do have a question, Mike. I want to make sure I answered before we finish up here. We've learned to look beyond the headlines. For instance, we took great pride in the fact that our occupancy was up. Our rent collections were actually better post-COVID than pre-COVID. I mean, people were just paying their rent on time. So we learned a couple of things from this. Number one, I said, look beyond the headlines. If you look at the headlines for real estate and rent, they showed rent decreases last year. They showed occupancy dropping. If you took out the big markets, New York, Boston, Los Angeles, San Francisco, Seattle, you take those markets out of the equation, it was kind of stable. Those were the markets that really suffered. In fact, the 5 largest cities in the country lost 500,000 renters in about a 3-month period last year. And the 5 fastest growing communities in the Southeast picked up 700,000 renters during that same period of time. But again, headlines just tell you averages across the country. So look beyond the headlines whenever you're considering investing. The other thing we learned, and I'm very proud of this, is the resiliency of renters. Again, a lot of people, again, I just don't know if they were in, depending on the city they were in, or if the rumor got out, you don't have to pay your rent. Our people paid rent. They didn't go on vacation last year. They weren't having to go to the dry cleaner as much. They weren't driving as much. They paid their rent. And the reason for it is because the vast majority of consumers out there are much more educated than you'd be led to believe if you listen to, pick your news channel. They knew that if they didn't pay their rent, it wasn't excused. It went on their credit report. They knew that the rental market was tight. So if they decide to just quit paying my rent and walk, and they go over to, Michael Corselli Apartment Complex Inc. and try to apply to get a rent, the first thing that'll pop up is he skipped on me. And now he can't find, that renter can't find an apartment because they have a bad credit history. People figured this out. They wanted to protect their credit. And at the end of the day, the 3 things that are important to people is taking care of their family. And that means putting a roof over their head and food in their belly. And that's what people did last year. They really rallied a lot more than you'd be led to believe. So that's what we learned. Look beyond the headlines and know your residents very, very well and work with them, and they're going to work with you. If you take care of them, they take care of you. That's been our motto from day one. We've always said returns to investors begin at the resident's front door. If you take care of your residents, that'll take care of your investors. The question I had was, could you disclose your professional parties, lawyers, auditors? Our lawyers are Herschler Fleishler out of Richmond, Virginia, one of the top firms in the country in putting partnerships together. They're not just good legal counselors, they're good business counselors as well. And we work hand in glove with our auditors, which is Weaver and Tidwell. They're one of the super regional audit firms in the country. We didn't use the big 4 because they were just so expensive, but everybody at Weaver and Tidwell came from a big 4 experience. And again, we use Weaver for a couple of reasons. One, they're consultants. They're not just auditors. They work with us all the time in helping us resolve tax issues. We have never sent our K-1s out late that required our investors to file an extension. Even though probably 97% of them do file extensions, that's not our decision. So we have always gotten our K-1s out on time, and I give the team at Weaver complete credit for that. Like I said, also, they're just good advisors for us. And then our fund administrator is Fleming Financial out of Baltimore, Maryland, a little town outside of Baltimore, actually. And they were brought into us by Weaver. Our funds are fully audited, by the way. And the other reason that we use Weaver is while we do quarterly net asset valuation adjustments for the properties, and we have a great data room for an investor portal for our investors, for those of you that are work with us, understand how good that is. And we report increases in NAV every quarter. And then on a yearly basis, and by the way, we're not compensated based on the NAV, so we're very cautious about raising the values of these properties. One reason we retained Weaver, though, is they do have a valuation division. And so at the end of each year, as part of the audit, they go out and third party evaluate the value of our properties, and they get the ultimate approval on whether or not those values are accepted. We can negotiate with them and talk to them, but at the end of the day, they haven't. So when you get your audited report at the end of the year, it's coming from a firm that has deep real estate experience, that has put a value on those properties, so you never have to worry about your properties being overvalued or undervalued. So those are the questions we have, and I think I'm kind of winding down at the end. Michael, any other questions you have, or anything I can do for you and Jeremy?
Working with you guys, I'm very happy to hear the success you've had and to watch the development.
Well, we appreciate you guys. Y'all ask good questions. You're not just a group that puts sponsors and investors together, but you ask us good questions. You serve as a filter for the sponsors. We appreciate that. I like the other sponsors I see on your network. You obviously filter them very well, and we're proud to be part of the FLAIA organization, and we're very proud of the investors from FLAIA that we've picked up into our fund. And we hope they've enjoyed the distributions, and we hope to continue to make those to them. But continued success, Michael. Real proud of what you guys have done as well.
Thank you, Ernest. Thank you for being a partner. We're proud to have you as part of the platform.
Take care. Thanks, my friend.
Thank you.
Stay well. Thanks.